The US job market is always hailed as unstoppable, but is it really as strong as everyone claims? The latest ADP Payrolls report hints at cracks beneath the surface. Maybe it's time to look past the headlines and see what's really going on. ADP, the payroll giant, processes paychecks for 1/5 of America's private sector. So when they talk jobs, it's real data, not guesswork. Their monthly report drops just before the government's big jobs number, giving us an early look at the labor market. Sometimes ADP spots trends before anyone else. Think of it as the canary in the economic coal mine. If you want to know if the job market's about to turn stormy, this is the report to watch. Now let's turn our attention to a key economic indicator that often sets the tone for the month: the May ADP report. This report, meticulously compiled, offers a preliminary glimpse into the health of the private sector job market. It's a closely watched metric by economists, investors, and policymakers alike, providing valuable insights into employment trends before the official government figures are released. And this time around, the May ADP report was, unfortunately, a bit of a letdown. The numbers painted a picture that wasn't quite as rosy as many had hoped. Heading into the release, Wall Street analysts and economists were generally optimistic, with consensus expectations hovering around 175,000 new jobs added to the private sector. This figure represented a healthy, albeit moderate, pace of job creation, signaling continued economic expansion. However, the actual figure fell short of these expectations. The report revealed that the private sector added only 152,000 jobs in May. Now, let's be clear, 152,000 new jobs is still positive growth. It's not a disaster by any means, and it certainly doesn't signal an imminent recession. But, when compared against the anticipated 175,000, it's undeniably a clear miss. It suggests that the labor market might not be as robust as previously believed, and that discrepancy, that gap between expectation and reality, is what's making people nervous. It raises questions about the underlying strength of the economy and the sustainability of the current expansion. Drilling down into the sector-specific data, we see some concerning trends. Manufacturing, a key bellwether of economic activity, experienced a loss of 20,000 jobs, and the leisure and hospitality sector, which has been a consistent source of job growth in recent years, barely added 12,000 jobs. This slowdown in hospitality could be indicative of changing consumer spending patterns or broader economic anxieties. Even professional and business services, typically a reliable engine of job creation, lost 6,000 jobs. This is a particularly worrying sign, as it suggests that even white-collar sectors are feeling the pinch. These aren't just random blips or statistical noise. They're not isolated incidents that can be easily dismissed. They suggest that key sectors of the economy are indeed slowing down, experiencing a deceleration in their growth trajectory. When the usual job engines, the sectors that consistently drive employment growth, begin to sputter and falter, it's a sign that the whole market, the entire economic ecosystem, might be facing headwinds. It suggests that the overall economy might be cooling down, transitioning from a period of robust expansion to a more moderate pace of growth. Now, Wall Street, ever the bastion of composure, won't shout about it from the rooftops. They tend to prefer a more measured and nuanced approach, but make no mistake, this is a trend worth watching closely. It warrants careful monitoring and in-depth analysis, because the foundation of our job market, the bedrock upon which our economic prosperity is built, isn't quite as solid and unshakable as it might appear on the surface. There are cracks emerging, subtle weaknesses that deserve our attention. When the monthly jobs report comes out, everyone's watching. We're all eager to see if the economy is creating enough opportunities for people. But what happens when the numbers fall short? Fewer jobs than expected is one thing, indicating perhaps a temporary blip in the economic radar. But when we start to see slowing wage growth, that's when economists and everyday people alike start to get a little nervous. It's another red flag, a signal that the underlying health of the economy might be weakening. It suggests that the demand for labor is not as strong as we thought, and that has ripple effects throughout the entire system. Wages for people staying in their jobs, those who didn't switch companies, are a key indicator of overall economic health. These wages grew 5%, down from last month. That might not sound like a huge drop, but it's a trend we need to pay attention to. It means that companies are becoming less willing or able to give their existing employees significant raises. Job switchers, those who took the plunge and moved to a new company, often see a bigger boost in their pay. But even that pay bump saw a drop sharply, falling from 9.3% to 7.8%. This is a significant decrease, suggesting that even the most mobile workers are finding it harder to command higher salaries. When raises shrink, when people aren't seeing their incomes increase at the same rate as before, they start to make different choices. People spend less. They cut back on discretionary purchases, they postpone big-ticket items, and they become more careful with their money. And that hits the whole economy. Consumer spending is the engine that drives so much of our economic growth. Consumer spending drives 70% of U.S. economic activity. It's the lion's share. So if it slows, so does everything else. A slowdown in consumer spending can lead to a decrease in production, which can then lead to job losses, and the cycle continues. Businesses are getting cautious, they're seeing these same warning signs, and they're starting to adjust their strategies. They're hiring less, being more selective about who they bring on board, and offering smaller raises to their existing employees. The ADP report, which tracks private sector employment, suggests we're edging closer to a real slowdown. It's not time to panic, but it is time to pay close attention to these economic indicators and be prepared for potential challenges ahead. Is a recession coming? Not from one report, but this isn't happening in isolation. Layoffs are up even in tech and media, and hiring freezes are spreading. The Fed's interest rate hikes are making borrowing tougher, cooling the economy. If rates go too high, we risk tipping into recession. The May ADP numbers are a warning light, not a siren, but they're hard to ignore. Wall Street may spin it, but the data is clear: risks are rising. So what does all this economic uncertainty really mean for you, the everyday worker, the average investor, the person just trying to make ends meet? How does this intricate dance of economic forces trickle down and impact your daily life? First off, job security gets shakier. The ground beneath your feet at work might not feel as solid as it once did. Because when hiring slows, when companies become more cautious about expanding their workforce, layoffs can come faster and with less warning. Restructuring becomes the new buzzword, and suddenly, no one feels entirely safe. And raises, they get harder to win. Companies tighten their belts, and that annual salary bump you were hoping for might just not materialize. If you're job hunting, brace yourself. Expect more competition. The pool of qualified candidates swells as more people find themselves searching for new opportunities, and fewer openings. Companies become more selective, and the number of available positions dwindles. Those big pay bumps for switching jobs, the kind that used to make jumping ship so tempting, they're shrinking. Companies are less willing to offer substantial increases to lure talent away from their current employers. Even if you're not actively changing jobs, don't think you're immune. A weaker market can rattle your investments, especially those retirement accounts you're counting on, and your retirement savings. The nest egg you've been carefully building might suddenly look a little less secure. Everything's connected. It's a complex web of cause and effect. When the job market cools, it touches everyone, from the CEO to the entry-level employee. The tempo is changing, the rhythm of the economy is shifting, and it's smart to pay attention, to stay informed about what's happening in the world around you. Wall Street won't warn you directly, they speak a different language. But these trends matter for your wallet, for your financial well-being, and for your future. So, should you panic? No, but don't ignore the signs. The ADP report is an early warning, not a final verdict. These subtle shifts are clues that the economic weather could change. Staying informed helps you prepare, not just react. Use this data to make smarter choices about your job and finances. The job market's cooling. Be ready, not scared. Sometimes the best move is to check your financial umbrella, just in case.